Good morning and welcome back to Almus Market Mornings. Going into this weekend, one major event risk was the Japanese upper house election on Sunday. Preceding this event, markets were set up quite nicely for the loss of the ruling coalition and maybe even PM Ishiba stepping down. The alternates were parties that would go aggressive in fiscal spending, and the result was higher Japanese yields, especially on the long end of the curve. Now that the event is behind us, the loss has crystallized, but PM Ishiba has decided to stay on. Let's try to understand what all this means for the markets. Good morning, JK. What's your read on Sunday's event and what should our listeners look for this week?
Morning, Swaraj. So the Japanese upper house election has been better than what the market had been prepared for. Ishiba will continue to stay on as he himself stated, and they got a little more seats than the market had thought about. Out of 51, he got 47, and of course he will have to depend on coalition, but not as weak a position as the market had thought about. That's the reason why the Japanese markets have actually improved. Japanese yen gained about 0.5%, and the stock futures are showing about 150 points higher. Japanese market are actually closed today. Which we'll watch for how the negotiations go on between the coalition partners on the budget, on fiscal spending, etc. So I think this event is over now. The other event the market was looking forward to, but not with great hopes, was the Chinese monetary policy. But China kept their long-term and medium-term lending rates steady. Although recently they had stated that they have many tools to address boost the domestic consumption. But perhaps they are waiting some more because the tariff issue with the US is something that is not yet, clear. On Friday, we had another, strong data from US. It was a week in which we had many strong numbers from US. And on Friday, we saw the Michigan Consumer Survey. Although it's a forward-looking data and it's not a hard number. Uh, Consumer sentiment improved. We also had importantly the inflation expectations improved, both for 5 year as well as the 1 year inflation number. Some skepticism because the market may still face some issue as the tariff numbers are finalized, but at least for now, that was some comfort. Though these inflation expectations are higher than where they were in December, it's come down, so that's some sort of a comfort for the market. And another thing, a non-economic event, of course, some statements from the Fed member Christopher Waller, who's considered as an influential member of the Federal Reserve. He once again pushed for a rate cut in the upcoming meeting on 30th July. Although in FedWatch tool, market still shows 95% probability of a no change, but he has laid out a detailed case for Fed to cut rates sooner. He says Fed rate tariffs, sorry, the tariff influence are going to be one-off, and they do not cause inflation beyond a temporary surge. And he also said the data argues for monetary policy to be close to neutral and not restrictive. And based on how the labor market has been, that also provided some relief to the markets. Uh, then, of course, we had quite a number of companies in the US reporting better results, the major banks and also the consumer related companies. So all these things kind of, it was a positive scenario as far as the US is concerned. And we had already seen CPI and PPI come lower than expected. Retail is big beat was the and then manufacturing was also improving. So all these together, it was a good scenario. Stock markets, of course, since they were at all-time highs, so there was some profit-taking seen. Week on week change was much less, but they still S&P 500 and the Nasdaq actually stay at all-time highs still. What can look forward to this week is not too many numbers from US. We have only the durable goods numbers and some home sales data, but we'll have the flash PMIs from various regions, including Asia, Europe, and US, to assess the level of activity. And German IFO business sentiment will be there, and UK retail sales. These are the numbers that we look forward to, in this week for seeing how the market goes. Uh, we had the yields come off from the highs for several reasons were there for that, because we had inflation expectations lower. Japanese inflation actually printed lower, which we reported on Friday. Trump proposed a higher tariff of 15 to 20% for Europe, which gave rise to some sort of a risk of bond buying. And inability of 30-year to hold above 5% and 10%, 10-year above 4.5%, also encouraging some more buying. Particularly since stocks trade at all-time highs, so there is some sort of a distribution between from stocks to bonds, is what we can see. The most importantly, the tick data on Friday showed that foreign investors who had sold a lot of treasuries, or their investments had come down in April, had made up the entire reduction in the month of May, and infusing more than 30 billion into fresh investments in US treasuries. So the concern about wholesale sell-off in the US assets, particularly in the bonds by the foreign holders, is somewhat now reduced, and that's a reason why dollar is also now slowly holding out, not crashing. Although the major issue for the markets, which I think is more riskier than the tariff issue, is the Powell's status. Although Trump denied of any move to remove him right now, market still sees that as a possibility if there is any legal case built up for his removal. So in the meantime, Valor is saying dovish expectations, and also even saying that he's ready to accept the job as Fed chair if he's appointed, although he's not yet been contacted by Pod. So I think this issue will remain in the market focus, apart from the number of data points from other regions that we are looking at. For rupee, again, a host of companies are reporting somewhat disappointing numbers, particularly in the financial side. Banks, reports say that the non-recoverable, or rather the NPS of banks have gone up, and the provisions have also gone up. And another data says that in India, the loan growth has come down substantially to 6% from more than 10% that was seen, 11% that was seen last year, and that's also possibly due to slowdown, particularly in the urban sector, which market is seeing. So that's the reason why Indian stocks are also seen somewhat subdued. Not There's no crash as such, but there are signs that it could correct more. Uh, for FI flows have been very minimal, and most of it was only to the IPOs, and we know that excess money from IPOs always go back. Uh, Reports also say that in India, FDI has been much lower this year compared to last year. Although we are not dependent on FI flow and FDI flows for the meeting our current account deficit, but I think these flows are important from the point of view of investments, and also without these flows, rupee is unlikely to gain much, despite even the further fall in the dollar index. So that's what. So Indian assets are right now looking a bit unattractive. There are also reports that investors are looking at lesser, or rather undervalued markets like South Korea rather than India, which is seen to be overvalued. So rupee traded again weaker. Now it is comfortably above 86, and breaking 86 at 25 we can see 86, 50 also. So now that the dollar index is also on a corrective up move, that is very much possible. So overall, not going to be as data packed as last week, but this week we'll have a market looking at Fed member statements and the other data numbers, few data numbers that are coming out before Fed meets on 30th July for their policy decision. Thank you.
Thank you, JK. And of course, this week we are looking for some flash PMIs, German IFO, and Fed member statements. More hints on whether July is going to be a status quo or a cut can be expected. Though markets as of now expect the rates to be steady, but some influential voices like Christopher Waller has advocated for a rate cut even in July. On Friday, of course, we had the strong data from US on consumer sentiment, which showed some improvement. Inflation expectations improved for 3 year and 5 year. That is lower inflation expectations, and all of this resulted in the yields coming off from the highs. Because the inflation expectation, which is a major cause of concern for the Fed, that came off. Chinese monetary policy was kept. Chinese monetary policy rates were kept steady, and of course, we already discussed the Japanese House elections. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates. Thanks.